If a founder acts like they need my money to survive next week, I instantly recoil. When a founder says to me, I'm free whenever, I hear like nobody else is interested. Fundraising is not about convincing skeptics. It's about finding the believers.
Okay, welcome back, everyone. We've got a great guest today. His name is Chef Abdullah. He is an active angel investor, board advisor, super connector, mostly in the tech ecosystem. He's had 17 investments in the last 4 years and 2 successful exits. And he really bridges the gap between technical execution and strategic capital, which is so helpful if you are on the other end of his capital to get his advice. His journey began as a software engineer writing code, evolved into founding his own company, scaling and exiting his own ventures. And now he brings the operator first perspective to early stage investing and really helping founders navigate the challenges, because there are many, of fundraising and growth. And I saw his LinkedIn post start popping up and I was like, oh my God, he's talking about like so much good stuff here. I asked him to be on the podcast and he so kindly said he would. So Chef, welcome. So nice to have you here.
Yeah, thanks for having me. Absolutely. Hope it's going to be something hopeful, like helpful for the founders and for the audience. But yeah, always happy to help.
Oh, no, it's amazing. I think the kind of insights you provide are just incredibly helpful because they are very real and you've been through it. And I'm just going to say this. I've seen a lot of investor or, VC partners posting on LinkedIn. And a lot of them, I'll do a quick check of their background and they don't have that real founder experience of having been in the trenches. So anytime there's an investor who's really been there, I think it's just so helpful. So I appreciate what you're doing. We're going to talk today about a few different things. He just did a talk on fundraising at Web Summit, and he's going to provide some insights there. He is going to talk about why a bad investor is 10 times worse than, money in general. And then mistakes to avoid if you're structuring your first round as a safe, some really key tips there. And then the post that caught my attention, the 2-week vacation test. And this is something I have done and really hits home for me. So I'm excited to talk about that. Also, Chef is actively looking for investments. So if you are a founder and you fall into the fintech, ad tech, or health tech space, he's actively looking for investments in the US or UK. So definitely follow him on LinkedIn. He posts so much great content. And you never know, maybe he'll be your next strategic partner. So Chef, let's dive in. Tell us real quick a little bit about where you're at. Just give us kind of like your human side of your background for in a couple minutes here before we jump in. I think it's a fascinating story you have.
Right. Yeah. I mean, you touched a little bit on that, but my foundation is in tech. So I was a software engineer for over 13 years. And then work mostly with US customers and UK, a few UK customers, but that's also why I'm focused in US and UK, because there are markets that I understand, the legal side, taxation, everything, how business is conducted, basically. So that, and then I founded my own multiple ventures, had a few small exits and a meaningful exit about 4 years ago. And that kind of, I reached a point where I was thinking to myself, I go on and build one more company to solve one more problem, or leverage all I had gathered over the years in terms of capital, but also expertise, as well as my network, to go on and help other founders, build, 20, 30, 50 companies, hopefully, that would solve as many problems. So that's what I did, of course, decide to leverage all that. And that's what I'm doing now the last 4 years. I've been just an angel investor, advisor, and mentor. I've done 17 investments to date. I've got one that I've not announced yet. So publicly it's listed as 16, but I will announce on one. And I've got 2 exits already completed. So yeah, that's roughly where I'm at. And my focus is what you mentioned in fintech, ad tech, and health tech, US, UK.
Amazing. Congrats. What a great story. And what a great pivot to start helping other entrepreneurs rather than just, your own venture. Very cool. So
I'm loving it. That's what I wanted to say. I'm loving it so far. I do have like 7, 8 meetings a day with founders when I'm not in events and stuff. So I love all of it. Helping founders it just gives me so much joy. But
yeah, to be in the position to be able to do that. Because I know for me, a lot of people helped me along the way. And it is nice to, not everyone out there is there to help people. So yeah, it does. It's very fulfilling. I would agree. So I'm sure that's
absolutely.
why.
But there is also one thing. The way I see it is because I don't read news much myself. What I do is I have these meetings because the founders are actually the ones that are in their own respective vertical. They're the ones who have got most of the knowledge, but also they know what the future is bringing. So I love to learn that before it actually happens, and I use that as a way for me to to keep up and update myself on what what's coming in the future, instead of just reading boring articles.
What already happened, right?
Yeah.
Yeah, no, it is very invigorating. I love that. Good point. Okay, let's start off. So you were just at this web summit. You did a talk on fundraising. Let us know, what kind of insights did you share? What kind of recommendations to startups are you giving them?
Yeah, I mean, I did this fundraising mentor hour web summit in Lisbon some weeks ago. So basically, I structured it in 2 kind of sections. The first one was the mindset change, and the second one was the tactics that you can use to help you in your fundraising. I've seen all kinds of advice, but I thought that this would be something that would definitely help founders most, because I see this as something that gets so many founders to fail on the first minute that they're approaching the fundraising process. So on the mindset side, I touched on 3 points. The founders should definitely feel and understand that they are the prize. So it drives me crazy when founders pitch like they're begging for a favor. Okay, I'm not looking for a subordinate. I'm looking for a peer, and I have the capital, which is the commodity, but the founders have the equity, which is something that's scarce. So I want them to feel that they have the right of, like they're interviewing an employee. So that's how they should see it, not as something less than that. That's the first one on the mindset change, but also on the second one, the smell of desperation. There are those times where founders, if a founder acts like they need my money to survive next week, I instantly recoil. It just, that's what happens to me. So I want the founder, who says that the train is leaving. You can get on, or you can watch it go. So that's how you should position it, and because the confidence is the only currency that that will most definitely get the checks. So that's the second point on mindset. The third point, and I think this is something that especially first-time founders do a lot. They treat investors as gods. We are not gods. we are peers and you should treat us as such. So when they call me, I don't know, Mr. or Sir or whatever, that's, or they're like overly differential, it's a turn off basically. So it tells me that they don't value their own asset enough. So don't do that. Don't they're your peers, so position them there on the same level with you. So that's how you're gonna get the investors' respect.
I love that you made all three of those points. I totally agree. For some reason, we put the money up on this pedestal, and people undervalue their passion, their drive, and their time commitment. And it's like you said, that's a rare thing. It's not, somebody has an idea and they're willing to actually pursue it and dedicate their whole life to it. It's like that should really be considered and is equally valuable. Like it is completely.
No, it's more.
Yeah. It's completely a partnership.
You can find money from someone else, but you cannot find someone else who's going to solve what you're trying to solve, because if there was someone else, they would already be doing it. So that's the scarcity of it. Money is commodity. You're going to find it from someone else. You can find it from someone else. So
No, I totally agree. I love that. No, I think we'll get into the other stuff, but not all money is equal. Not all entrepreneurs are equal. But I think when the entrepreneur is pitching, to just, with all the rejections you're going to get, it's just usually it's a basic, not the right fit at the right time. It's not that this person has something over you. You know what I mean?
Yeah,
so yeah, thank you for touching on that.
Yeah.
I love that. Okay, go ahead.
And the other point, the other part of that mentorship RO was more on the tactics that they can use, to get investors to now. Some investors are not going to like these secrets that I'm going to share, and they're, contrary to me. But I love helping founders. I said it in the beginning, and I will say it again and again. I love helping founders because I've been there, and I want to make their path as easy as I can. And on the tactics, one of the most, it's cliche, but it's the one that works, is the most effective, is the scarcity. So calendar density, basically. So when a founder says to me, I'm free whenever, I hear like nobody else is interested. So, I would respect more a founder who says, I'm doing the first calls, the week of, I don't know, of the 12th only, let's say. So it signals that there is demand, and forces me to move, to reposition myself, say, okay, things are moving along there. So something is going on that has got. Now, you don't have to absolutely fake this, but try to get those meetings in a 2 weeks time frame or 1 week time frame, and when you're going to start the process, then you're going to hold the investor meetings only in that time frame. That's that will basically be engineering the FOMO. But yeah, it's a cliche, but it works. So definitely a tactic that you don't leave out. The other tactic, owning the elephant in the room. So investors are risk managers. So we will find the risk. So if you try to hide it, it will kill the deal down the road. So to be the most effective, it's put those the biggest weakness you have and you think of, put them like front and center, and touch on them as much as you like give an actual explanation why it is like that and what is your plan for tackling that. If you have a high customer acquisition cost, talk about it, why it is so, and how are you going to improve on it. So anything, so that's how you're going to get the trust of the investor, because if you leave them high and dry, in the sense that They will think of the risk that's there, but they don't find the answer anywhere from where, even before that they're asking the question. They will ask the questions, but then sometimes they will forget the question, then will just stay on their mind. They will just keep it for themselves. And so you don't want that. You want those risks to be front and center, and then actually explained how you're going to, why they are so, and how you're going to tackle them. And the third tactical secret that I shared with the founders there is the soft commit. Do not open do not start raising without having a soft commit first. So like, do not open the round without that. So I would respect founders who build the momentum before opening the round. It comes down to actually having those relationships with investors way before you're going to actually open the round, but also, when it will come to the moment that you're going to open the round, first you're going to have them in that time frame that I talked about, like 1 week, 2 week window. But also, before you actually open the round, you approach them and you ask them, if we open the round next week, would you be opposed to participating? Careful here. I negated the question because now, instead of just giving you a direct no, they have to actually justify it. So it's very easy for them to say, it's very easy to say no in the first, do you want to invest? No, and they just leave. But if they're going to say, yes, I'm opposed, now it opens up the door for you to ask the questions why exactly they would be opposed. And that's valuable data that you cannot get any other way. So you definitely need to be able to have that window there so you can, drill down and learn a little bit more what's not aligned with them at the moment. So yeah, I mean, in a sense, it shows like the emotional intelligence. It gives me an easy way to be honest without the pressure of like saying no. So and people are more, so study this huge psychological the negative, I think it's called negative questions or something. So in psychology, but if you research it, you will love these kinds of questions. And yeah, I mean, wrapping up the whole mentor, the whole mentor hour, I made it clear, and I'll make this clear also for your audience, that fundraising is not about convincing skeptics. It's about finding the believers. That's all. So yeah, those are like the insights that I shared at Web Summit.
If you are raising money in 2026 and you do each of those things, I feel like you are 90% more likely to close a round. So that was like gold advice, Chef. Amazing. You don't hear people talk about those things, and those things have nothing to do with the business model. They have nothing to do with like the team. It's like this human part of it that is so critical.
It's all human.
Yeah.
It's all human. It's all human. Yeah.
And it's very similar to sales and dating, right? So it's like, it's total sales. So, oh my gosh, that was gold advice right there. So thank you for sharing those. And I think, coming from someone who is actively out looking for companies. One quick question there. So I get this question a lot, and I recommend the same thing: build the relationships before you're ready to ask. So if someone's approaching you, what's the email that will get you to take a meeting? Assuming the business model, the space, it's in the right fit. Is it just, hey, I'm getting ready to raise funding, this year, and I'd love to get your feedback on what I'm doing? Or what's kind of any nuanced messaging there that you'd recommend?
So, I mean, with any kind of communication, the first communication when you reach out, I'll tell you from my side. But I've talked with other investors as well, and I see them following kind of the same path. When we are getting that message, the very first thing we're doing is we're scanning to find out if the opportunity is aligned with our investment thesis. So if you start right there and then by mentioning why you believe this opportunity is aligned with the investment thesis, for me, I invest in fintech B2B. So you say we're a fintech, for B2B based in US, and then so first talk about the alignment, then just highlights. Well, the stage where you're at, how much you have raised, how much, what's the traction so far, just highlights. And then what's the problem shortly, what's the solution you've got, and then the call to action. So basically, you're just trying to ask for a meeting. That's all you're trying to do. Ask for the meeting. Don't try to do many things at the end, and make it so easy. So it's going to be frictionless for investors to actually book a meeting with you. Send the calendar link. It frustrates me. I see founders doing this over and over again, where I have to, reach to them and exchange a few messages until I get to the point where I get the calendar link. Just make it so easy. You don't want that friction there. Now, for me, maybe some other investors make themselves also available for pitching. I'm not sure, but I have actually pushed my calendar link publicly, and it fills up so quick. So I allow only 2 months ahead of booking time, and as soon as the day comes, it fills up. So it's so hard for me to find a way to actually give them the calendar, because it will get shared around, and founders will book the spot. But what I can do is, there are some founders who have booked a spot that are not aligned, and I can look in your calendar, and if that's a time where I can cancel on mine and then book on yours, then I can squeeze you in that spot. But if I do cancel someone and then tell you, go and book, it's gonna take some time for you to get the message, and then when you're gonna go look in my calendar, it's gone, it's not there anymore. So that's why, make it so easy for investors. That's kind of the structure of the message that you want to send out, and make the call to action right there and then.
Love it. Another easy way to stand out. Okay, let's jump in. So each of these you've done a post on, and I think, again, go follow him on LinkedIn and check out all of his posts, but we're just touching on a few of them that are really touch on some important stuff for the person who's just thinking about going out to raise money. A lot of times people think, I just need the money, right? But money from a bad investor can just be a nightmare on a lot of levels, on a really severe, it can get really ugly. So talk to us a little bit about that. What would you recommend, or what do you have to share there?
Yeah, I mean, a bad investor, I've said this publicly, why a bad investor is 10 times worse than no investor at all. So it's on two levels. The toxic cap table makes it uninvestable opportunity. So and I have had to pass on companies that I loved. But I had to pass because the previous investors ruined the cap table with predatory terms, and it's heartbreaking to see a great founder, with an uninvestable kind of deal, and more because of the bad, terms that they accepted. And when you accept these bad terms, it does not signal to me that you will have the right mindset for judging, how you're going to manage my money and the risks you take and don't take. So that's kind of, that's kind of what spooks me off, and other investors as well. It's not only me who you're going to spook off with bad terms accepted. So it's, a bad investor is not neutral. It's not harmless. So they are the actual active value destruction. They will destroy the value. And what that does also with these bad terms in most of the cases, it will either be some form of control, like overly exaggerated control on the decision-making process, probably some enforceability on the region you have to move to be able to get that investment. Sometimes there's going to be lots of these bad liquidation preferences and stuff that's really nasty. But but the most important part is also they kill the incentives for founders. Sometimes. So the founder will reach a point where it doesn't excite them anymore to actually go on and build. It also limits the founder's arsenal in some cases, because they have taken so much equity from them. So if the founder does not have that much equity left, they cannot go and incentivize advisors. They cannot incentivize employees. They cannot, work out with the equity for other rounds that they're going to raise. So that kind of in itself seals the failure of the company, and it's so counterintuitive. Like it works against the investors, and I don't know why they're doing it, but some are so, they're shooting themselves on the foot in some way. They're sealing the failure of the company. Yes, you can get 50% of the company, but if it fails, you can have 100% of it. It's going to be a fail. So it doesn't make sense. Leave the incentives there for the founding team to for them to be able to be excited to do and bring this to the world, but also for them to be able to incentivize others that are going to work with them. So the things, you touched a little bit on that, but there are, I would say, three things that I warn founders, that I advise about, and I mentor. So don't chase the shiny objects. They're chasing like the highest valuation or the famous brand name, or and they're forgetting the human element. It's not, the company name was going to, of course it does help a little bit, but at the end of the day, even in huge funds, it depends on who your partner is. So it depends on that human factor. So don't go and just, look for the shiny objects out there. The other part, the second thing I warn them about is watch out for those easy yeses. You don't want those easy yeses. So I've seen this sometimes, where founders love the guy who just wires the money without asking questions, but to me that's a red flag. If they don't do the diligence on you, are they really serious partners? So, what exactly can they help you with? So, and the third thing is you touched a little bit on this earlier, but it's the marriage analogy, basically. So, what I tell them is you're not just buying the check. You're entering a 10-year marriage without a divorce clause. So there is no divorce in this. In that sense, if you don't find somebody who's going to be the partner in the trenches with you, not just the guy who claps when the graph is going up. You want them to actually help you with value creation in the company, with a network, with whatever they can, provide you on top of just the capital. So those are like the things that basically destroy value: bad terms, bad investors, and
Yeah, so many great points. I think another thing that people forget often is a lot of times those first investors you're bringing in, when you go to raise another round, they will help bring in other investors, right? People they know, hey, this is going well, and recommend their network. So if you get the easy money and they aren't, in as a partner, you might not be able to lean on them if they're like, oh, this didn't turn out the way I thought it would because they didn't ask any questions or who knows, right? It's really is a partnership because and for a long term, like you said, so you want to be able to access resources down the road. So you want to make sure it's the right fit and that they know what they're getting into, like you said, and that you're kind of working together along the path. So that's great advice. Love that. Amazing. Okay. So on that note, how you get into those bad terms, I think is, for me personally, it's like attorneys are worth every penny. There's a lot of ways you don't have to now, safes are a much easier way. But what I always did was ask my attorney, what are all the ways this could go wrong? And it's not to have a negative mindset. It's just to understand what the terms mean and what the risks are. So what mistakes have you seen people make on safes that really backfired on them?
Yeah. So I have shared actually about a very, very, it would have been a bad case of company loss at some point, but it happened with me, luckily. So on the safe agreement, there is a clause. It's called the discount rate. And in that clause, you basically have to write the final percentage that if you're going to give a discount, of course, to an investor, and but if you don't, then you don't have to write there, like you don't have to use the safe agreement with discount. But if you are going to give a discount, that on that clause, you actually write the final percentage that the investor is going to pay. So, an example. If you're going to give a 20% discount, you don't write 20% there. You write 80%. Because if you write 20%, it means that the investor will pay only 20% of the price of the next round, like the equity round you're going to raise. And it's so easy to mistake it for a discount. And because people, when founders and investors talk, we say, discount was the discount, and then some founders might just go on and write it there as what the discount actually is, but that's a big mistake. Now, in this particular case, the mistake was even bigger because the founders. First of all, we had not agreed on a discount. That's why I kind of caught this right away, because they sent me a safe with a discount in it. And then I went through and I saw that they had written the actual percentage of the equity that I would own after the investment, which was 1.5%. And they wrote as 1.5% in the discount rate. What that meant was that for the next equity round that they would raise, I would pay only 1.5% of the price that these other investors would pay. So in effect, 1.5% is about 66.66 times out of 100. So I would get, for each share this new investors would get, I would get 66.6 shares. And that means that, they would lose basically the majority of the company to me.
Yeah,
but
of course, no new investor is going to want to
right away. I mean, if they didn't catch that, they would lose the whole company on the next round directly to me, because but definitely, I caught it and I told them right away, this is a huge mistake you made. But at the end of the day, on the legal side, if I had signed it, I would be entitled to that, because contracts don't, they don't care about mistakes. You made the mistake, you pay for it. So be careful with those, with especially with that clause. But there are others as well. And like you said, I totally agree on talking to your lawyers for all documents you're sending and signing. It's really worth the money. Do not skip on that step. Whatever you're getting in terms of contracts, or whatever you're sending in terms of contracts, always have them checked out by the professionals, because it will save you down the road in headache, capital, or whatever. So don't make that mistake.
Yeah. No, that is, wow, that's scary. Yeah, that's crazy. I think too, something that happens, I've been in this position, just recently did something a few months ago where I was kind of fatigued by the end of negotiating the deal. And you get a little bit fatigued, and then the final docs come over and you kind of just assume your attorney's read through them all and double checked all those little things. But go take the time with a clear head and go through it yourself. It's worth it. You know what I mean? So really having ownership over what's in there, even if you do hire, which you should, a good attorney to, look out for you and anybody you're bringing in. It is worth going through the docs yourself carefully. So I totally agree with you there. That is crazy. Wow. They are lucky that you were a kind person.
Yeah.
Oh my God.
I told them this is going to be a story we're going to laugh down the road a lot, and when we call it. But yeah.
Oh, wow. Amazing. Okay. So let's shift gears a tiny bit. So that's all the getting the funding, you've closed the funding, or even maybe before. I think it's tough as founders. It's so easy to just get completely wrapped up in your company, to put your entire life on hold because you're just success, whatever that is for you, is just around the corner. And you just think you can go 110 miles an hour, 24 hours a day. And you don't take vacations. But that's also a red flag to investors or acquisition partners. And this is something I've gone through. I did last year. I took a 6-week test and it pretty well held together. But by the end, I got back and I was like, ooh, there's some stuff that fell apart that I wasn't aware of. And it made me really rethink the whole operation. So I love this 2-week test. What's your perspective? Explain what that means to you and how you approach that with early stage founders, as well as post funding. What's your perspective there?
Yeah, I mean, so in essence, the whole point of that is to find out if they're building a company or just a high stress job. That's what will help the founders basically understand. So, and for that, I have this litmus test, and I asked the question. But this is more on the when they're trying to scale. Basically, it's not for the very early days. Even though you can start working on this on the early days, but it is especially important when you will reach the product market fit, and then you need to scale up. You definitely have to have gone through this process and be at that level where this litmus test basically will pass with perfectly. So the question I ask is, if you vanished, let's say tomorrow for 2 weeks, and you had no access to email, no Slack, no phone, what happens to the company? Okay. If the company, so if the company will survive, that's great. You have built it right. But if not, then you're not good. And there are the difference between those who are going to make it and not make it. On the one side, the red flag. If the founders start sweating, and I know that they're basically the bottleneck. They view being indispensable as a badge of honor, but I view it as a single point of failure. You don't want that. But those on the other side who have got it all done right, they'll say the team has got it, and that's the answer you want, because that makes it an investable business. You can invest in that business. So for reaching that point, there are three important things that I advise them on. The first one is get everything out of your head. Even in the early days, don't keep the information only in your head. So if a process exists only in your head, like in your memory, it will be a liability. So what I do with the founders I mentor and advise is I push them, write it down, create a playbook, document the process. Okay, don't keep things in your head, because you will reach that bottleneck point. The second thing is it's important to delegate the problems, not the tasks. There's a big difference here. So, basically, they should stop creating employees. They should create owners. So they should not be telling them, let's say you want to increase conversion, let's say by 10%. You don't tell them, change this on the website, do that. You tell them, I want you to increase conversion by 10%. And they should be the one figuring out how to do it. You tell them what, and that's it. Let them figure out how and what else they need to do to actually reach the point that you want them to reach. You have problems you want solved, ask them to solve them. Don't tell them, how they solve, how they should be solving it. And the third point is, I see, especially, first time founders, like not that many time founders, that do this mistake a lot. They don't let the fires burn.
Oh, that's so hard. Yeah.
Yeah, this is the hardest advice I give. Because I've been there myself. But let the small fires burn. Because if you swoop in and try to fix every little mistake, the team will never learn how to handle the big ones. So let those fires, let them figure out the things before you get agitated and start feeling like you need to jump in. Let it happen. Let it play out. This is like with who has kids. You learn this at some point, that you should not be interrupting them unless they're not, until they're in some unsafe place or position. If they're safe, just let them understand their own world. It's the same thing with employees. If you jump in on each step they try to take, they're not going to grow, and they will not be the actual ones that will handle the weight. You will be handling the weight, your own weight and their weight as well, because they are dependent on you.
Yep. Wow. Great advice. I learned a lot of those lessons the hard way. I think another thing too is that when you're in a founder situation in the early stages and you hit the inevitable bumps and things get stressful, that's, for me anyway, that's when it's easier to go, I need that feeling of, okay, I need to control everything, and acknowledging that, you know what I mean? And being able to step back from that in those moments. It's easier to do when everything's going amazing and, you're on an upward swing. But when you hit some bumps, really acknowledging that you still should apply those principles, I think can be really, really helpful.
Absolutely, because otherwise you don't have a company. You have a job. You're an employee.
Yep. No, it's so true. Amazing. Wow. Incredible advice. I love it. Just so on the human level, which is something why I do this podcast, because I feel like there's so much content out there that doesn't dig into this, layer, which I think is so important. So I really appreciate it. Anything else you want to share today?
I mean, I guess that's helpful enough. But yeah, if they want to learn more on what I share, because I do share a lot on LinkedIn, these kinds of insights. So, feel free to follow along on LinkedIn. You're going to find lots and lots of contents there, like on the posts, but also I do these kind of podcasts from time to time. So, you'll catch those recent episodes that I've been in. And also I've done some live streams before. If you want to go on my feature section of LinkedIn, there are two important ones that I want to highlight. The one, the first one is called Idea Validation Framework that I've got. And I have live streamed all that on how you actually validate your idea before you start building, spending time and capital on building things. So you need to validate your idea first, and that framework will tell you the steps you need to take to actually validate the idea. And the second live stream I've done is called Zero to Fund It. And it basically walks you through the steps you will go through to raise funds. And in there, I also share about the structure of the message that I touched a little bit earlier in this podcast, in this episode. But there I touch in detail what you need to include in the first message, which will be really important. And if I would give just one final thought, I guess it would be go and execute. Stop overthinking. Push the product out to the customers. Get feedback. It doesn't matter how ugly it is. It doesn't matter how much more you need to work on it. You have to work with the advice from the customers, because I see this mistake, a lot, and where you like founders hesitate, but also they get the wrong advice. And what I tell to my mentees is, investors will have opinions. Advisors will have opinions, but the customers have the money. Listen to them. They'll pay you for solving their problem.
Amazing. Well, thank you so much. So much great advice. We'll put your LinkedIn profile in the show notes so people can click through there. And thank you so much again, just for taking the time. So fun to connect, and look forward to watching your LinkedIn posts going forward and sharing them. And hopefully we can send some great founders your way at some point. Would be fun. So
yeah, that'll be great. Thank you for having me. Loved all this, and glad to help.
Wonderful. Okay. Thank you, Chef. We'll see you soon.
Thank you.